Hello traders, welcome back to the Forex Geek channel. Have you ever entered a trade thinking that a trend would continue only to watch price suddenly reverse? Maybe you had identified a sell trend like this and then you just entered after this lower. Can you see that this is a lower high, lower low, lower high, lower low, lower high, and maybe you just entered a sell trade here, and before you know it, a reversal happened. So have this happened to you before? If this has happened to you before, then I guess you would want to watch this video, okay? Because that is because you are not watching for divergence signals. Divergence is one of the most powerful tools for spotting reversals before they happen. And in this video, I'm going to show you the best divergence indicators you'll ever need for day trading. All right. If you want to master trading strategies that actually work, make sure to like this video and subscribe to the channel for more in-depth trading content. Now, in this video, we are diving deep into divergence trading, how it works, the best indicators to use, and how to apply them in real market conditions. Okay, let us just quickly get started. Now, in case you are not familiar with the concept of divergence, let us first of all look at what divergence actually mean in trading. All right, divergence happens when price action and an indicator move in opposite directions. For example, if you are using a momentum indicator and you notice that price is making lower lows and that momentum indicator makes higher lows, it shows that a divergence is occurring. All right. So when price action and an indicator move in opposite directions, this is a strong signal that the current trend is losing strength and a reversal might be coming. Now, there are two main types of divergence. We have regular divergence, which signals a potential trend reversal, and we also have hidden divergence, which indicates trend continuation. Okay, so divergence works because indicators reveal momentum shifts before price reacts, giving traders an early heads up on potential reversals. Okay, not all indicators are good for spotting divergence. Here are the top three divergence indicators that every trader should know. The first that we are going to be looking at is the relative strength index, or the RSI for short. Okay, now this is one of the most popular divergence indicators. Okay, you should be looking out for the RSI making a higher low when price is making lower low. That's a bullish divergence. So can you see what happened here? Can you see that while price made lower lows, can you see that the RSI made higher lows? Can you see that? And shortly afterward, we had a bullish reversal. Okay, this is for a bullish divergence. Now, if it is a bearish divergence, you're going to notice you're going to notice the RSI making lower high. You'll notice the RSI making lower high while price makes higher high. So when that happens, it's a bearish divergence, and you can see that we had a bearish reversal afterwards. Okay, now this actually works best on higher time frames. If you want to use the divergence signals, focus on higher time frames like 1 hour and above, 1 hour and above for stronger signals. The next indicator we are going to be looking at is the MACD, moving average convergence divergence. All right. So the MACD measures the relationship between two moving averages and helps spot momentum shifts. You should also look for divergence between price action and MACD histogram or signal line crossover. Like what we have here, you can see that this was a bearish divergence, which the RSI indicated for us. Price made higher highs, indicator made lower highs, and that is also what happened with the MACD. You can see price made higher highs, but the indicator made lower highs, and after that we had a bearish reversal. You can see the MACD also identified this bullish divergence as price made lower highs, but the MACD made higher highs. This was a bullish divergence, while this was a bearish divergence. Okay, so the MACD is great for confirming reversals, especially when paired with price structure analysis. Now, the next divergence indicator we are going to be looking at is the stochastic oscillator. The stochastic oscillator. All right. So the stochastic oscillator identifies overbought and oversold conditions while showing divergence signals. So you should be looking out for the stochastic making lower highs while price makes higher highs. In this case, you can see the stochastic gave us the bearish divergence around here, while price made higher highs. You can see that the stochastic gave us lower highs around here, right? So this is a bearish divergence. Then for a bullish divergence, you can see when lower lows were being formed, you can see that the stochastic gave us higher lows. Can you see that this was a bullish divergence? Okay, it works well for short-term reversals on lower time frames. You can also use it for long-term reversals on higher time frames. Okay, so now that you know the best divergence indicators, here's how to actually use them in your trading strategy. The first step is to identify the divergence. You look for price making higher highs or lower lows while the indicator moves in the opposite direction. Then the second step is to confirm with price action. Do not just enter because you see the divergence, okay? Look for confluence with support and resistance zones, trend lines, key zone. Make sure that there is a price action confirmation basically before you jump into the trade. All right, look for strong reversal patterns like engulfing candles. For example, you can see that here we had a bearish engulfing. Can you see that? A bearish engulfing took place before. You can even see a bearish engulfing and a shooting star. Or is it a dragonfly doji? A bearish engulfing and a dragonfly and a gravestone, sorry. Because gravestone is for sell, while dragonfly is for buy. So this is a dragonfly doji that occurred after the bearish engulfing. So that even validated the reversal further. So make sure you get confirmation from candlesticks as well. And then you can enter your trade, set your entry, set your stop loss. In this case, you can enter, set your stop loss above the swing high, some pips above the swing high, okay, not too tight to avoid liquidity sweeps. And then your take profit level can be at key support levels. All right, you can use key support levels for your take profit. This is the case of a sell. If it's a buy, you can use key resistance levels. All right, so by following these steps, you can increase the accuracy of your trades and avoid getting caught in false signals. Now, divergence is powerful, but many traders make mistakes when using it. So here are the top mistakes to avoid. One is trading divergence without confirmation. So always wait for a reaction at key levels. Make sure you get your confirmation, price action confirmation, whether candlestick patterns, chart patterns, just make sure you get a confirmation, okay? And do not make the mistake of using divergence on low volume markets, because divergence works best when liquidity is high. All right, divergence works best when liquidity is high. And do not ignore the overall trend direction. Use divergence with the trend for the best results. All right, do not also make the mistake of not combining divergence with market structure, because indicators should support price action, not replace it. And that is how you identify and trade divergences using the best divergence indicators. Now you know exactly which tools to use and how to apply them in real market conditions. If this video helped you, hit that like button, subscribe to the channel, and drop a comment below. What is your favorite divergence indicator? Let us discuss. Turn on notifications so you never miss a high value trading video. See you in the next one. Happy trading.